and welcome back to IG's Trading the Markets podcast. Today, we're going to be talking about what is likely one of the most feared words in any economy, and that is recession. After a spectacular rebound from the pandemic lows, the rapid rise in consumer and energy prices has taken the markets by storm in the last 18 months. But inflation is a double-edged sword, and whilst it signals a pickup in economic activity, it also leads to the slowing down effect on the speed of economic growth. There has been concerns about this for a while now, with the word stagflation being chucked around for the past 9 months or so, but it seems like the recession warning signals are as high as ever right now. Joining me today to talk about how to spot a recession and how to trade it is Paul Sedgwick, a director at Frank's Investments. Welcome, Paul. Let's kick it off first with the definition, or something that everyone's talking about right now, the main recession signal, it seems, at the moment, and that is the inversion of the yield curve. So, just to put it in context, during a normal economic growth cycle, long term yields will reflect short term yields plus a premium for risk and duration. But that seems to have changed now. We've seen this 10-year, 2-year yield inverted, going below zero last week. And that's what everyone's pointing at now as the main signal of recession. Now, I know there's a lot more factors to it, and we'll get into those in just a second. But just this indicator alone, what does the inversion mean?
Well, it's interesting. There's the sort of saying in the stock market that says that the yield curve inversion has predicted 10 of the last eight recessions. So there is sort of it doesn't automatically follow. And you have in the last few years, I think it was 2018, 19, you had an inversion of the yield curve and you didn't actually get an economic recession. So it's not given. A lot of people focus on the 2-year, 10-year, which, as you quite rightly pointed out, did invert last week. It yields of the 10-year have risen above that of the 2-year again recently. So that inversion has is reverted. But the Fed like to look at the 2-month 10-year as a much better indicator, and that's where economists are starting to focus as well. And that curve has actually steepened this year because as high yields have risen faster than the shorter dated ones. So actually, the signals I would say are a mixed one. And I would also say that's a case of the economic data that we're seeing. I mean, if you look at the City Surprise Economic US Surprise Index, that's been rising recently, suggesting that the economic data is coming in a little bit higher, a little bit better than analyst forecast. Against all of that, there are these concerns that whenever the Fed starts to tighten, that there will be the risk that they tighten too quickly and that forces a faster slowdown than the market was anticipating, and then you get an economic recession.
Yeah, you were talking there about the Fed and the tightening cycle, and we'll go into that in just a second. But you also mentioned how, the yield curve inversion, even though it's now picked up once again, as you were saying, isn't necessarily an immediate signal or signaling that an immediate recession is happening. Now, if we look at the previous times or the most notable ones being 1998 and 2006, where we saw that yield curve inversion, there seems to be a duration of about 10 months to a year between the signaling of the yield curve inversion to the actual recession. So, is that potentially, if we were to consider this as a true signal of recession, does that mean that we wouldn't likely see it until next year?
Yeah, that's a very good point, Daniel, and that was actually the point that I was going to lead on to. Yeah, I think you make the valid point there that actually that it is a portent quite often of an economic recession, but it's quite often sort of a year away from when the curve starts to invert initially. So it doesn't necessarily signal that we're immediately going to get an economic recession, but I guess it's a sort of warning sign, if you like, that the risks of an economic recession have risen.
A lot of economists and a lot of market analysts are pointing at the yield curve, the bond market, as one of the main indicators because of what we've seen in the past. But what else are we having to look out for as signals of recession? Because you were mentioning just then that the economic data is actually coming out better than expected. Unemployment keeps on falling in the US. So is it just the bond market that people are seeing these signals, or are we meant to be looking at other things as well?
Well, the picture we look at the moment, obviously, so we've got to put everything into context, I guess. I think we had a faster recovery than the market expected in economic growth last year. I mean, economies grew faster than they were forecast to at the sort of when when people were forecasting what would happen post as the global economy opened up after the pandemic. So therefore, some slowdown of growth is only to be anticipated. As you quite rightly point out, employment in America is employment rates is around about 3.6% of the unemployment rate. Job openings are strong. So the underlying economic picture at this moment in time, you saw the service sector PMIs came out the other day. You look at other economic data points, and it actually shows at the moment that other leading indicators are suggesting that at this moment in time, the US economy is reasonably robust. And but obviously there is a risk that people start to worry about, investors start to worry about, as the Fed does start to tighten monetary policy, that the risks of an economic recession and a slowdown do begin to get greater. Obviously, inflation is something that the markets are focusing on a great deal at the moment, and why the Fed are starting to tighten. The causes around the current rates of inflation are less about demand, but more about supply. The fact that you just can't buy things at the moment and this has been exacerbated by the war in Ukraine, which is actually which has pushed up food prices and some raw material prices and that sort of thing, putting further inflationary pressures into the system. And as you saw last night from the Fed minutes, the Fed will now look to shrink their balance sheet faster than they did in 2019. So there's going to be quite a lot of monetary tightening, and it will be quite hard for the Fed to engineer a soft landing as economic growth does slow a bit, inflation rates do start to rise, or probably stay persistently higher, and also they raise interest rates.
Yeah, so the central bank has a lot of influence in what's happening in the economy. And a lot of people are starting to say that potentially the yield curve inversion that we've seen this time around is not as easy potentially to read as we've seen in the past because we have so many factors going on. You were mentioning about Ukraine there, and obviously that's an external factor that in the last month or 2 months has had a lot of impact on energy prices and commodity prices, and that obviously all factors into consumers and then the ability of consumers to spend. But also, there's a view that the Fed is potentially behind this yield curve inversion because we've seen persistent inflation and they're trying to catch up to the rapid rise in prices by rapidly rising interest rates. And I mean, we have so much expectations over the next few months. I think 50 basis points in May and 50 basis points following the next meeting, and so
Yeah.
forth for the next few meetings. So what impact does the Fed, and can we potentially isolate this inversion as okay, this is happening because of these expectations of the Fed, and not necessarily we're going to see this big recession next year?
Well, the answer with hindsight, the Fed would probably argue, yes, they should have tightened quicker. I think at the time they were thinking about the fact that they weren't 100% sure how quickly the world would recover from the pandemic, and didn't want to, having spent trillions of dollars, three times what they spent to support the economy during the pandemic, three times what they spent during the financial crisis. I think that they were keen not to dampen down the economic recovery too quickly until they were certain that the pandemic was becoming more of something which the world was getting used to, and was having less of an impact on the global economy. So I think that they bided their time. They felt that at the time that inflation would be more transitory than it is, and that inflation rates would start to fall quite quickly. Now, I would imagine if you asked any of them, they would say, well, with hindsight, the economy was probably a little bit stronger than we thought. The effects of the pandemic did unwind themselves a little bit quicker. And yes, we should have started to raise rates and shrink down our balance sheet a little bit quicker than we have. And the risk is now that the market worries about the fact that because they didn't do it then, they have to go harder and quicker now. Quite how this all plays out with higher interest rates and basically the lack of supply of goods and inflation rates we shall see.
Yep. So, do you think, again, going back to watching out for signals in the market, for anyone that's trying to hedge their portfolio against the risk of a recession, do you think that as we move along in the next few months and as monetary policy becomes more evident and we do essentially start to see the Fed raise these rates, are those fears of recession going to get bigger because people are going to see that effect on the economy, or do you think that's going to play out in the next few months?
Well, I tell you what I tell you what I think that there's this term peak hawkishness. I actually think that there is a possibility. There are signs, or there were signs that inflation was starting to ease, so that some of the inflationary pressures, metal prices were coming off, shipping rates were coming off. They've actually started to pick up again a little bit as China has locked down certain parts of certain regions again due to the pandemic. They're zero, so shipping rates have to. But over the last couple of months, there were signs that inflation rates were starting to drop off. So I had sort of thought that there was a possibility that if this did happen, the Fed are, are very much in a very hawkish mode at the moment, might become a little bit more dovish in the coming months. We shall see if that is the case. But I think that obviously economists, strategists, investors will look at the economic data and what that's telling you, and seeing whether some of the leading indicators that we follow are starting to weaken and raising the risks of an economic recession. You talk about how you can protect yourself in an economic recession. Well, obviously, economies shrink, and at times, and you do have economic recessions. It's part of the economic cycle, and it's very hard to protect yourself as an equity investor. You have to look at it more in the sense that these create opportunities rather than sort of worry too much about the fact that it's going to happen, because it will happen. They do happen, but they do also create opportunities when it does happen. Obviously, you want to be less cyclically geared when you're coming into an economic recession, so your portfolio should be less geared to cyclical stocks, ones that are more geared to the economic cycle. That makes you much more defensive in a way. So that's one thing you should think about when you're looking at your portfolio, is what's the makeup of your portfolio. Tech stocks tend to lead, growth stocks tend to underperform during rising rates, because obviously the discount rate makes them look less attractive. So you might find tech starts to underperform a little bit if rates do continue to rise.
Great. You were giving, some really good ideas there. And I think this notion that about defensive stocks, and it's something that everyone talks about. Oh, if a recession is coming, you should get into these defensive stocks. But as you were saying there, they also create great opportunities to enter the market recessionary periods. Let's quickly finish off here talking about gold, because gold has always or traditionally been seen as a safe haven, somewhere where people will place their capital when they see worries in the stock market or in traditional assets. What's been happening with gold lately? Because we haven't seen it perform in the way it has in the past. Usually, it performs inversely to US yields or yields in the market, in the bond market. And it's kind of been playing a side of it recently because of what we've been seeing happening in the market. Would you still consider gold a good place to place your capital when you are concerned about other areas of the market?
Well, you see, gold is one of the, I think gold I would describe as like Marmite. Some people love it and some people hate it. I'm in the camp, I don't hate it, but I'm in the camp where I feel that there are better opportunities to there are other asset classes I always much prefer. The thing about gold is obviously it is an inflation hedge. It's supposed to be an inflation hedge. It's also a zero. In fact, it's a negatively yielding asset because you have to pay to hold it, basically. So it's a negative yielding asset. So when yields rise, the attractiveness of gold reduces. But also as inflation increases, its attractiveness increases because of the fact that it can't be devalued. It's a store of value because governments can't issue more of it. So it's a difficult one. Personally, I think a lot of people like having a bit of gold in the portfolio. It gives them some security. It's considered a store of value, and I think to have a percentage, a modest percentage in your portfolio makes perfect sense. Um, but as a you have to be very, very bearish of the world to have a major part of your portfolio in gold. And I think, like anything in life, my personal view is you diversify, you hold assets in different asset classes, and they tend to protect you in different points in the economic cycle. Concentration is always a risk, a greater risk. Having a bit of gold in your portfolio, you wouldn't put off anybody against that.
Thank you very much, Paul, for joining me here on IG's Trading the Market podcast. That was Paul Sedgwick, director at Frank Investments, giving us his view on how to spot a recession and also how to trade and cover a portfolio during it. For more videos from us here at IGTV, join us on Twitter at IGCom, Instagram, and subscribe to our YouTube channel.